In this video, I'm going to go through the 3 biggest tax mistakes that every retiree makes. Any one of these mistakes can cost you thousands of dollars in retirement and completely change your retirement lifestyle. Now, whether you're just stepping into retirement or have been enjoying retirement for years, these pitfalls are lurking around the corner. I want you to know exactly what these pitfalls are and how to avoid them. Let's get started. So the number one mistake is placing way too much money in qualified accounts. Qualified accounts are accounts that you never pay tax on. So these are very common types are 401k accounts and IRA accounts. These are monies you place dollars aside into, you are getting a tax deduction. Think of it like a bucket. And then when it comes time for retirement, when an individual starts taking distributions or withdrawals from this bucket, they're going to be fully taxable. Well, how does it affect things? Well, it affects things on 3 main levels. First, it's going to affect your tax brackets. Second, it's going to affect your Social Security income. And third, it's going to affect something known as IRMAA surcharges. So how tax brackets are affected is the more money that you're pulling out of qualified accounts, such as your 401k, such as your IRA, the higher your tax bracket will be, meaning the more money that you have to pay to Uncle Sam and the IRS. So when someone's collecting more dollars from their qualified accounts, it's going to increase their adjusted gross income and their modified adjusted gross income. Those numbers are crucial to understand because that is what could affect how much of your Social Security benefit is taxable. The higher your modified adjusted gross income, the higher the calculation is that determines whether 0% of your Social Security benefit is taxable, 50% of your Social Security benefit is taxable, or up to 85% of your Social Security benefit is taxable. So you need to fully understand what are certain accounts that you could pull from to reduce that modified adjusted gross income number. So in translation, it could decrease or completely eliminate any of your Social Security benefits from being taxed. So one of the most overlooked situations is something called an IRMAA surtax or surcharge. And really what it is just a tax. This was something that was developed in 2003 to help the solvency of Medicare and Social Security. When somebody is on Medicare, when they hit age 65 and they go on Medicare, they have to pay Medicare Part B and Part D premiums. If you're above a specific threshold, meaning you're making too much money, and that's based on modified adjusted gross income numbers. So if you're above a certain threshold or your tables or tiers above a certain threshold, you're going to have an increased premium amount, meaning an increased cost for that Medicare Part B and Part D premiums. At the end of the day, what does that mean? That means that less dollars is going to go into your pocket and more dollars is going to go to the government's pocket. So the second mistake is ignoring required minimum distributions, also known as RMDs. This is important because when an individual is constantly keeping their qualified accounts, their IRAs, their 401ks as an example, and they're holding onto them and not spending those dollars down, the government's going to force you to start taking dollars from that. And that's exactly what a required minimum distribution is. So if we understand like how an IRA works, an individual cannot start touching those dollars until age 59 and a half, before age 59 and a half, or else they get dinged with a penalty. Well, if they wait too long, you have these things called RMDs, which used to be 70 and a half. Then it got changed to 72. Now it's currently age 73. And then in 2033, it's going to be age 75. So what that means is when somebody hits age 75, as an example, there's a minimum amount of dollars that they have to pull from their qualified retirement buckets. And that dollar amount increases every year that they get older. Why would the government do that? Well, the government does that because they understand anytime you take a distribution from a qualified retirement account, you need to pay taxes on that. So it's the way on how the government gets their tax money back. So rather than just leave that money in a deferred account and then leave that as some sort of inheritance, what the government does is they force you between a rock and a hard place. They said you can't touch this money before age 59 and a half. We're going to force you to start pulling it at age 75 as an example. So if you do not touch it by age 75 or whatever your RMD age, then you're going to have a penalty. That penalty could be upwards of 50% off of what your required minimum distribution is. So let's say if we use the example that somebody has a required minimum distribution of $10,000. If they did not take their required minimum distribution, then they would be penalized $5,000 in that example. So that's obviously a large problem. Now, if you remember with mistake number 1, I was discussing individuals throwing too much money in qualified accounts. When they're throwing too much money in qualified accounts, what it's going to do is increase the required minimum distribution. The required minimum distribution increases each year that they get older. So if, let's say their first RMD was at age 75, and then they're going to have a higher percentage, a higher required minimum distribution at age 76, a higher required minimum distribution at age 77, et cetera, et cetera. So if somebody's living into their 80s, at age 80, their RMD from a percentage-wise is going to be significantly higher than what it was at age 75. Once again, the government's doing this so that every time you're taking a withdrawal, you have to pay tax on that. Well, what else is happening as you're pulling out a withdrawal? Well, it's also increasing your taxable income. So just like mistake number one, by having too much money, by claiming too much money or taking too much withdrawals from qualified accounts, now that's going to affect how your tax brackets work. It's going to affect how your Social Security income, or what benefits of your Social Security income, is going to be taxable. It could be subject to that 50% or up to 85% taxation off of each dollar of benefit, of Social Security benefit. And then it could also push you into the IRMAA threshold with the IRMAA surtax. So if we're taking that required minimum distribution situation a step further, what's essentially happening with that RMD? Well, the RMD is going to be fully taxable, whatever that dollar amount is that you take the withdrawal on. After you pay taxes on those dollars, then you're going to be reinvesting that. That could now be sitting in a taxable or a non-qualified account. So you want to make sure that that's set up efficiently and effectively. Any additional dollars that you're removing or that you're collecting throughout retirement, plus the RMD, could increase your tax bracket. It could increase your Social Security tax. It could also put you into those IRMAA thresholds. And then when that individual passes away, those dollars are going to be fully taxable to their beneficiaries. And there was a change that was made known as the Secure Act, which changed the entire functionality on how individuals can leave their qualified retirement accounts, such as an IRA, to their beneficiaries, and how fast that their beneficiaries need to liquidate those accounts that they're receiving. It all comes down to how can the government get their tax money the fastest possible way. And this is going to segue now into mistake number 3. So the third biggest tax mistake that retirees make is the unfortunate situation of death of a spouse. Now, be mindful what's happening when you have a couple that's living throughout retirement. They're going to be at the tax brackets of a married filing jointly. When you have one spouse that passes away, that next year, the widow will now be filing as a single, as long as they were not remarried. So the single rates are significantly higher from an income perspective than the joint rates. What do I mean by that? Well, if we're just using 2025 as an example, if you had a married couple and they made $96,000 of taxable income, they would still be sitting at the 12% tax rate, marginal tax rate. If, let's say, one spouse passes away and the remaining spouse is still receiving that $96,000 per year, that individual is now going to be sitting, because they're at single filing rates, will now be sitting at a 22% bracket. So instead of reaping all the benefits of that extra income, they now have to add significantly more dollars, thousands of more dollars, and send it back to the government, back to the IRS, because now those monies are higher on a taxation standpoint. When we transition over to the Social Security conversation, when I was talking about provisional income is a combination of Social Security income plus modified adjusted gross income. Well, there's different limits when an individual is a single filer versus if they're a joint filer. So what that would translate to is an individual could be fine. They could be maybe sitting at 50% of their Social Security benefit is taxable, or 0% of their Social Security benefit is taxable. All of a sudden, their spouse passes away, and now 85% of their Social Security benefit is taxable. And then they're also thrown into a much higher tax rate because they went from joint to a single filing status. And to piggyback off of the death of a spouse conversation, comes down to inheritance maximization. What happens with a lot of individuals that are retirees is they may have their budgeting analysis already, covered, and they understand what their income sources are, what their discretionary monies are. So all of their excess accounts, they want to leave this into some sort of bulk related inheritance. Well, since that Secure Act took place, it changed the entire landscape off of the functionality on how beneficiaries, non-spousal beneficiaries, are able to receive those dollars. So before, in the past, an individual was able to stretch out what those payments are for if they were a child or some sort of non-spouse beneficiary. Now what it's saying, or really since the Secure Act, is saying that that individual has to drain down those retirement accounts, those inherited retirement accounts, within 10 years. So therefore, the government's getting their money faster, and that can now also place the individual that's inheriting that benefit in a much more detrimental position because they cannot kick that tax can down the road any further. So there's really a kind of triple-edged sword that's going on with the death of a spouse. One is now this individual sitting in a single filing status. Two is it could affect their Social Security income, which we understand could also affect IRMAA and all those other tax bracket situations. And then three, from an inheritance maximization standpoint, it could completely bite them in the butt. So now that you understand the three biggest tax mistakes that all retirees make, what should you do from here? So here at Ifasi Financial, we created a three-step process for any individual watching this video to overcome what the three biggest tax mistakes are that every retiree makes. So step one shows you how to save thousands of dollars on your retirement taxes. You need to simply click on the website that's shown in the description of this video with step one. And what it will do is bring you to a personalized retirement tax bill site, which will create a customized report for you. We'll show you exactly what your tax bill will look like and reveal custom Roth conversion strategies tailored just for you. This first step is crucial, especially when it comes to understanding and avoiding the three common tax mistakes that every retiree makes. Step two is more customized to create some sort of roadmap. So this is for the individual that may be a little bit lost and they do not really understand what their financial journey is and really what their retirement gap looks like. So what this does is a 15-question quiz. It's known as ifasiquiz.com, and you'll notice that URL in the description of this video as well under step two. And what you would do is customize your answers to what really pertains to your goals. And from there, you're going to instantly receive a custom report that will show you what your gap is and the different areas that you need to focus on. Step three, which is by far the most important, is to get a customized feedback. Now, this is something that you could either call a 1-800 number, which is 1-800-566-1002. You could simply click on the Calendly link attached in the description of this video. Either of these options, what we try to do is make it as convenient for you as possible to speak with an advisor. And because you watch this video, you would simply reference this video and you would have access to your free 20-minute connection call. Either one of these three steps could definitely help you on your retirement journey, and I wish you the best of luck. Please make sure to subscribe to our YouTube channel so you can have access to the most updated videos. Thanks so much, guys.